Hi, everyone. My name is Joseph Argiro. I'm the founder of Fish Network. And today we're going to walk through a tool that we developed to help emerging managers determine the correct and optimal investment vehicle or vehicles for them as an emerging manager. So we're going to look at the different trade-offs between syndicates, or more specifically, the single asset deals or SPVs done inside those syndicates. We're going to look at investment funds as well as investment clubs. Now, all of these different vehicles, three of them, have different quantitative and qualitative trade-offs that are better or worse for certain people based on their unique skill set, background, and goals. So if we look at the assumptions, the inputs here will be used to help the system to determine what the optimal vehicle is for you. So the things we'll look at are the number of deals that you want to do, the average check size for investors. Now, typically what we found is that majority of investors will actually just put in the minimum check size. So whatever you set the minimum to, the majority of your investors are going to write that. For example, if you set your minimum check size to 5K for a syndicate, most people that are investing in your syndicate, we're going to put in 5K. So keep that in mind. Now, the vehicle size is a function of the number of investors and the average check size. And you can see that that's calculated here. Now, also what we're going to look at is the percentage of the investors in your community or network that are accredited. Now, this obviously has an impact over which investment vehicle is right for you, right? So if all of your investors are accredited, then that makes it more applicable to actually use the fund, right? Since everyone's accredited. Whereas in an investment club, not everyone needs to be accredited. We'll also take a look at social capital. Now, this is not talked about enough as emerging managers in determining how strong your social network and personal brand is, which can drive additional investment at the margin. So we at Fish Network take this into account, whereas most professional emerging managers just kind of leave out the social capital and personal brand piece, which we think is a differentiator. So you'll select how strong you believe your social capital is for high, medium, low. And then we'll also look at how active your investors are, meaning, do the investors want decision control over their capital? Do they want to be involved in picking the investments? Do they want to be involved in diligence, post-investment operations? And this will also play a huge factor in determining what the right investment vehicle is for you when it comes to funds broadly, but syndicates specifically. If you're going with a traditional GP/LP structure, most of your investors are actually trading money for time. They don't want to be involved. So that would actually drive this number down, right, in G5, because you'd have more passive investors, a smaller number of active investors, right? So it's important to ascertain, how involved does your investor base want to be? Now, when it comes to an investment club, we want people to be active. So that's also a key differentiator that most people aren't aware of. And then on the right here, we just have some standard return multiples. So 3x multiple on capital is the magic number in venture capital, just determining kind of is a VC fund, or better yet, a VC firm going to make it to fund 2, fund 3, fund 4. And if they're able to return 3x capital or more, that's a really, really good indicator that they have something that can be built for the long run. Now, most funds and syndicates take a decade to realize an exit. So we assume a 10-year fund life, an 8% hurdle, and these metrics can be changed based on what your return profile is, and it'll help you calculate downstream different fees and profits in the long run, which can be shown in the chart section. Now, this is good information to read. I won't regurgitate it here, but this just gives you a deeper analysis over how these different dimensions, investor activity, vehicle size, number of investors, accreditation, and social capital, how do they impact this from a decision standpoint? How do they impact which investment vehicle you create? Okay, so let's move on and we'll talk about club, syndicate, and fund together. So what makes a club unique is that instead of charging management fees or carried interest, we are charging a flat organizer fee. Now, this is similar to a syndicate in that you're taking the money up front, right? Most syndicates charge an upfront fee, which includes the legal administrative costs and any leftover profits for the syndicate lead to compensate them for setting up the deal, right? And typically in a syndicate, this is between 2.5% to 5% of the capital, but it can be more. Now, in a syndicate, most of this fee is typically lumped together, so you actually don't know how much the syndicate lead is pocketing, which is just a transparency problem in private markets that we at Fish Network are actively trying to solve. How do we solve that? Well, in our model, we are transparent with the organizer fee and the administrative expenses. So we actually separate them out, and the organizer can earn a flat fee. So it's not a percentage of capital raised, and it's pre-disclosed to investors before they commit capital. So the organizer is getting a flat fee to facilitate the investment club, which invests in multiple deals. Okay. And what we see is that this club model is actually more efficient. If you look at deployable capital here, you'll notice that the club, see club as blue, the club will actually be a more efficient capital deployment mechanism because it's spreading the costs across multiple deals like a fund, but with none of the regulatory and compliance overhead. So this makes it a more investor-friendly vehicle because it's more transparent, it's more capital efficient, and it also enables investors to contribute and have some meaningful control over where that capital goes by working together with other investors in the club. Okay. Now, if we come back to, now let's move on to syndicate. So in a syndicate, like I mentioned, about 2.5% to 5% of the capital raised is used to cover the management fee, which includes the syndicate leads compensation. We just took an average here of 3.5% between 2 and 5%, which is standard in the industry. It's typically a one-time fee. And you, as from the syndicate side, you must incorporate the, let's say, 20% carried interest on profits. Now, what's interesting about the carried interest here relative to funds is that you'll notice that the carry is actually higher here for the syndicate. The reason that is because when you invest in a syndicate, you're not being anchored down by all the losers in the fund. And when I say losers, I mean the losing deals in the fund. So if you invest in 10 deals and 9 of them go to zero and 1 is super successful, those returns are being netted against the 9 losers, right? So you're earning carry as a fund manager on the aggregate, not on each individual deal. So that's something to keep in mind, right? And that's a positive for the syndicate lead, right? Because the syndicate lead is going to earn more carry on that deal because it's a single asset investment vehicle, right? So they're earning all of the carry. They're not being dragged down by the losers. Okay. So this model assumes an aggregate of a 10 admin fee, which is standard on angel lists. It also gets more complex when you add more investors and investors from different states and additional assets. This is just a good placeholder. And this SaaS fee is optional, but this is if the syndicate wanted to charge a SaaS fee or an access fee, maybe one time or yearly, just to get access to the deal flow, right? And some syndicates charge that, some don't. I decided to leave it blank so you can fill it in. So that's syndicates. Let's move on to fund. So for a fund, most people know that typically you're going to spend around $50K, maybe more, on the administrative expenses and legal setup. This includes a fund admin, which is around $1,000 a month. So let's say 12 to 15K a year. And these different service providers start to add up. You have your fund admin, your audit, your legal. At Fish Network, we're collapsing this into one standardized turnkey structure so that you actually don't need a fund admin. We have fund admin automated accounting built into the platform using blockchain for transparency and AI for automation, so that if you're moving around a couple $1,000,000 or a couple $100,000, you don't need a fund admin. One of the key benefits of Fish Network. So this is the fund side. Now, if we look into more the analysis, so again, these are our inputs over here from the assumptions tab, and we can calculate side by side the economic trade-offs between the different vehicles. Now, ultimately, when you put in your inputs and assumptions, the spreadsheet will spit out a recommended vehicle based on your social capital, how active your investors are, the percent of them that are accredited or not, how many investors you plan on bringing in, roughly, and the number of deals you want to do. Again, if you're only doing one deal, then a syndicate probably makes sense. But if you're doing multiple deals and you have a big personal brand and maybe half of your investor base is not accredited, then the spreadsheet will actually help you make the right decision over what is the right recommended vehicle. Now, typically we see investors, sophisticated emerging managers, coupling 2 investment vehicles together. Let's say a club and a fund, or a syndicate and a fund. And if you're looking to get into the nuances there, please reach out. We will help you determine that optimal structure of a primary and a secondary vehicle and how you can structure your firm to actually reap the benefits rather than the 2 models competing against each other. You want to have a synergistic and complementary approach. And typically 2 vehicles working together can be more powerful and you'll able to capture more value from your investor network by going with hybrid approach of two entities. Okay, so there's some very great analysis here that you should check out just so you can determine, just have a good understanding on the proper context of how this works. So if you look at the charts again, you'll notice that the organizer compensation is higher here. So for a club, so you can actually make more money up front in a club as the organizer, and that's because it's more efficient, right? You have less overhead and fees to pay as a syndicate lead. And as a syndicate lead, you're typically not making much money, or at least your ROI on time is not very good because it does take a lot of time and energy to organize an SPV. Similar time and energy that it takes to organize a club. And that's part of the reason why clubs are more efficient, because you're setting it up once, you can do as many deals as you want, everyone gets diversified exposure, everyone can contribute, and not everyone needs to be accredited. So if we look at deployable capital, typically the deployable capital for a fund is less, but if you spread those costs across multiple deals, then the capital efficiency of a fund starts to make more sense. If we assume 2% management fees over a 10-year fund life, well, that's 20% of the capital anyway. And in a club, you're able to take administrative expenses to pay for fees that are things to grow and market and the community, to give them the tools, your unique investor community, the tools that it needs to succeed. Similar to the way a fund pays for its rent and electricity out of the management company. Clubs on Fish Network allow you to do that. So that about wraps up the video. Hope this was helpful for you to understand the differences and nuances between investment clubs, funds, and SPVs. And if you have any questions, please feel free to reach out.